Hi, this is Ivan Illan. I am the founder and chief investment officer at Aligne Wealth Advisors Investment Management, also known as AWAIM. Thank you very much for joining me this month for this update. I have a few slides to share with you. It's been an interesting start to the year, uh, which may be an understatement from some people's perspectives. But the first slide I'd like to share with you is something that's quite notable from history regarding private fixed investment. It's not as popular a metric as most other econometrics, like, for example, PCE or personal consumption expenditures. People hear that on the nightly news. People don't normally hear about updates or changes in private fixed investment. Well, in our research highlight that we published on our website this month, we draw special attention to this particular metric because there seems to be a high degree of correlation between private fixed investment, or I should say, uh, reductions in PFI. When that is occurring, historically, that has meant a pretty big slowdown in GDP or economic growth. So this is something to pay attention to and keep your eyes on, uh, and also compare it to personal consumption expenditures, PCE. A lot of times, folks have this belief that once the consumer starts to slow down their spending, that has an impact on the economy. Well, in fact, as part of this research highlight, we share what the history throughout various recessions actually looks like. And by and large, consumption actually remains quite flat. In some instances, actually goes up a little bit during recessions or economic contractions, whereas PFI, or this private fixed investment, actually declines quite notably relative to contractions within GDP. This is kind of an important and an interesting item to focus on, namely because it is not in the nightly news and not something that's easily referenced or regarded, but something that I think holds some interesting aspect. And so on this next chart, this actually goes through the history between private fixed investment, personal consumption expenditures there in the green, and real GDP growth, which is GDP growth adjusted for inflation. And there's these different recessionary periods that are being highlighted here all the way back to the 1960s. But the historical average is the one that really is quite interesting to me, which really shows that consumption really holds up pretty well. And certainly there have been notable recessionary periods where some actual personal consumption grows during periods of recession. But certainly in every instance, you saw a significant contraction in private fixed investment. So go to our website, look at the research highlight, read through it. It defines what private fixed investment is. It could be surprising to you that, for example, residential real estate is a big component of private fixed investment. And so it is regarded in that category because households obviously are engaging in that. Any kind of fixed asset at all for that businesses allocate to or nonprofits would allocate to. So it's a very interesting research highlight that I encourage you to take a look at. This next chart is looking at the change in dominance between value type stocks or growth type stocks. And it really is somewhat cyclical. And we currently, all the way on the right-hand side of this chart, you can see that the price earnings spread, the differential between the values ascribed to value type stocks, which is there in the gray line, versus the dark black line of growth type stocks, you can see that it's a really huge spread there. And when you have this level of spread, what this chart is saying is that growth is expensive and value is cheap. And there has been some oscillation there over the decades that you've seen, but we haven't really seen this level of spread since really around that period of the dot-com craze and the dot-com crash. So that's an interesting thing to take note of. This next chart talks about year to date, we've been seeing some really tremendous inflows into equity funds, into European shares, European markets, and it's actually the highest in a couple of years of inflows. We've been quite happy with that because our clients are heavily allocated in non-US equities, and certainly Europe plays a large role in non-US equities within our portfolio. So this has been a nice support to our portfolio returns year to date. And all second to last, the percent of 90 plus days delinquent by loan type. This is something that's kind of been going on for a little while here, but this particular chart, which is somewhat dated because it was updated in the Q1 of 24, but it really shows a trend here, which is credit card debts have continued only to surpass this metric here of increased delinquency. But even as far back as a year ago, they were already showing a big uptick. Auto loans as well are also in that category. Things like student loans or home equity lines of credit are really not in any severe shape at this point. Mortgages have started to tick up a little bit as well, recent data suggests. But I think the point of this chart is to show that there's just such a stark history already over a year that credit cards have really been ticking up in their delinquency. And there's been a lot of charge-offs from banks that have occurred as a result of this. So banks have already started writing off this debt. And anecdotally, we've actually seen many banks just getting out of this business altogether of being in the credit card business, which certainly many banks are. And lastly, I think it's worth noting that businesses are really, capitalism is all about driving profit and having profitability. So looking at industries with the highest profit margins, I think makes sense, and I think it's a good idea to do. And because we get so overwhelmed by listening, to the news and business media, and it oftentimes focuses on just a couple of companies, you forget that there's actually a lot of other companies out there in the marketplace, and those companies and those industries actually have very, very good profit margins. And keeping in mind that a stock price, it's very simple to define what a stock price should be. A stock price today is simply the present value of all future earnings for that company. Said again, the stock price today is the present value of all future earnings for that company. So if you expect a ton of earnings for a company, then that's going to justify a much higher price, which is the discounted present value of all of those future earnings. Well, earnings is profit. And so, it's just a nice reminder that you really should take a look at the portfolio that you're invested in, making sure that you have some good diversification in place. Obviously, you can argue with tobacco and it being a vile, type industry and disgusting and gross and killing, millions of people a year. All right, at 32% profit margin, it's a pretty fat profit. But forget about tobacco because it has some questionable ethics and morals around that industry. Entertainment software, 27.4%. Retail REITs at over 25%. Diversified companies like Berkshire Hathaway or Honeywell, 25% profit margins. Rail transportation at 24%. System and app software like Microsoft, Oracle, it's almost at 23%. Financial services, excluding banking, at 22%. It's like Visa, MasterCard. Water utilities, boring utility companies, 21%. And then semiconductor equipment, 20%. Semiconductors at 20%. So this is an area of the market that's been getting so much attention. You can't go a single day, I think, without hearing about NVIDIA in the news. And when you look at their profit margin, for this particular industry, it isn't that particularly compelling. I mean, we know oil and gas, okay, at 19.5% profit margin, very capital intensive, heavy equipment, machinery, people required to get the black gold out of the ground. Semiconductors, you kind of have this idea that's a little bit more technology driven, but boy, those margins seem to be a bit thinner than I think most people might think. So that's an important thing to keep in mind. Asset management, our industry, 17.6% profit margin. Computers and peripherals, 16.8%. Oil and gas distribution, 16%. General utilities, 15.5%. So it's just a nice graph, I think, that Visual Capitalist does. They do a lot of very nice graphs. And this one succinctly depicts the industry net profit margin on average within that particular industry. And it's just a great reminder about valuations and the like. So with that will conclude this month's video update. And of course, if you have any questions at all about what's going on in our portfolios that we manage for our clients in our ACGM Total Portfolio Solution Suite, which is a tactical strategy across 4 core strategies, please don't hesitate to reach out to us. And thank you so much for joining me.